While the national headlines focus on federal interest rates and stock market highs, a quiet, far more dangerous crisis is metastasizing at the state level. It is a crisis of solvency. Across the United States, a specific group of states has entered what economists call a fiscal death spiral, a self-reinforcing cycle where rising debt forces tax hikes, which drives out productive taxpayers, which lowers revenue, forcing even higher taxes. In the current cycle, this breakdown is no longer theoretical. We are seeing it in the data. Massive budget shortfalls, crumbling infrastructure, and an exodus of high-net-worth individuals and businesses. For real estate investors and homeowners, this is the single greatest risk to your equity. When a state economy breaks down, property values do not just correct, they stagnate for a generation. We saw this in the Rust Belt in the 1970s, and we are seeing the early warning signs of it again right now. Today, we are analyzing the 8 states that are flashing the most severe signals of economic distress. We are looking beyond the surface-level unemployment numbers and diving into the structural balance sheets, the unfunded liabilities, the demographic outflows, and the commercial real estate exposure. But before we reveal the first state, you need to understand the liquidity trap concept that connects all of them. Most people assume that if a state gets into trouble, the federal government will bail it out. History shows this is a dangerous assumption. In the upcoming sections, we will reveal why a specific legal precedent set during the last major recession prevents a federal bailout for state pensions, leaving property owners to foot the bill. Number 8. Kentucky. We begin with a state that is currently serving as a textbook example of the pension crisis. Kentucky's economic breakdown is not driven by a housing bubble or a tech collapse, but by a legacy of debt that has finally become mathematically impossible to service. The state's public pension system remains one of the most underfunded in the nation. To put this in perspective, historically, a pension fund is considered healthy if it is 80% funded. Kentucky's primary funds have dipped significantly below that threshold in recent fiscal years. This represents billions of dollars in unfunded liabilities, promises made to workers that the state does not have the cash to keep. Why does this matter to a private investor or homeowner? Because when the bill comes due, the state has only 2 levers to pull: slash public services or raise taxes. In the current economic climate, Kentucky is attempting to do both. We are seeing a strain on infrastructure and education funding, which directly impacts property desirability. Historically, when a state's debt-to-GDP ratio climbs this high, credit rating agencies downgrade the state's bonds. This makes borrowing more expensive for the state, creating a vicious cycle that drains the budget further. For anyone holding real estate in Kentucky, the long-term appreciation outlook is being capped by this fiscal anchor. The state is essentially mortgaged to the hilt, and the equity of its residents is the collateral. However, while Kentucky struggles with internal debt, the next state on our list is facing an external shock that exposes the fragility of its entire business model. This next economy is proving that reliance on a single industry, no matter how lucrative, is a recipe for disaster when consumer spending contracts. Number 7. Hawaii. Hawaii is often viewed through the lens of paradise, but economically, it is currently viewing a precipice. The state faces a unique, geographic insolvency risk. Because of its isolation, the cost of living in Hawaii has always been high, historically hovering around 80% to 90% higher than the national average. But in the current inflationary cycle, that cost has shifted from expensive to prohibitive. The breakdown here is driven by the collapse of the service economy. Hawaii relies overwhelmingly on tourism. During the previous economic expansion, this was a strength. But as discretionary spending tightens globally, tourism revenues are softening. Unlike diversified economies that can pivot to manufacturing or tech, Hawaii has limited options. We are seeing a massive net outmigration of local residents, the workforce that keeps the islands running. They are leaving for the mainland because wages simply cannot keep pace with the cost of housing and imported goods. This is creating a labor shortage crisis that is stifling local businesses. When the waitress, the nurse, and the construction worker can no longer afford to live in the state, the economy grinds to a halt. Furthermore, the real estate market in Hawaii is showing signs of a luxury freeze. High-end properties that moved quickly in the previous cycle are now sitting on the market. The volume of transactions has plummeted. This is critical because the state relies heavily on property taxes and transfer taxes from high-value real estate to fund its budget. As transaction volume dries up, the state's revenue shortfall widens. Now that you understand how isolation and high costs can strangle an economy like Hawaii's, you must see how those same pressures are playing out in a completely different environment. The next state is not isolated by an ocean, but by a wall of taxation that is driving away its most valuable asset, its corporations. If Kentucky's pension crisis and Hawaii's isolation represent slow-burning economic failures, the next state on our list demonstrates the devastating speed of corporate flight. We are shifting our focus to the Northeast, where the breakdown is driven by a toxic combination of high taxation and an eroding business climate. This state proves that even with significant historical wealth, an economy cannot survive if its primary revenue generators, high-earning corporations, decide to leave. Number 6. Connecticut. For decades, Connecticut was the capital of the hedge fund industry. It attracted massive wealth and corporate headquarters due to its proximity to New York City and its high quality of living. But in the current cycle, that model has fractured. The state is facing a tax base erosion crisis. Historically, Connecticut relied heavily on the income tax revenue from its top 1% of earners. When the tax burden became prohibitive, coupled with rising estate taxes, wealthy residents began to relocate to tax-friendly jurisdictions like Florida. This is not a theoretical migration. The data shows a net outflow of adjusted gross income in the billions. When high-net-worth individuals leave, they take their consumption, their philanthropy, and their investment capital with them. This creates a budget hole that the state must fill by either raising taxes on the remaining middle class or cutting services. Connecticut has chosen a path of fiscal austerity that is impacting its infrastructure and public sector. Furthermore, the state's legacy pension obligations are a massive drag on its economy. Similar to Kentucky, Connecticut has significant unfunded liabilities. However, unlike Kentucky, Connecticut has a high cost of living that makes it less attractive for new businesses to enter. The result is a stagnant economy with limited growth prospects. Real estate values in certain areas have plateaued or declined in real terms over the last decade, a trend that is alarming for any long-term investor. But if you think Connecticut's tax problem is severe, wait until you see the demographic collapse happening in the next state. While Connecticut loses its wealthy, this next state is losing its entire working-age population. The brain drain occurring here is a leading indicator of a housing market that could be oversupplied for a generation. Number 5. Illinois. Illinois is currently the epicenter of the demographic death spiral. The state has experienced consistent population decline for years, losing residents to neighboring states with lower taxes and better business climates. In the current economic cycle, this trend has accelerated. The breakdown in Illinois is driven by a lack of fiscal discipline. The state has the lowest credit rating among all U.S. states, hovering just above junk status. This means Illinois pays significantly higher interest rates on its debt than other states, diverting billions of dollars away from productive investments like education and infrastructure. For property owners, the most immediate threat is property taxes. Illinois has some of the highest effective property tax rates in the nation. In some counties, homeowners are paying effective rates that erode their equity faster than appreciation can build it. When you combine high property taxes with stagnant home values, owning real estate becomes a liability rather than an asset. Additionally, the state's pension crisis is legendary. The unfunded liabilities are so massive that they threaten to consume the entire state budget. The pension squeeze forces local municipalities to raise property taxes even further to cover their share of the burden. This makes Illinois less competitive for businesses and less attractive for families. The commercial real estate market in Chicago is also flashing warning signs. High vacancy rates in the office sector are reducing the tax base for the city, which puts more pressure on residential property taxes. It is a vicious cycle where a shrinking tax base leads to higher taxes, which leads to a shrinking tax base. However, while Illinois struggles with population loss, the next state on our list faces a different kind of existential threat. This next economy is built on a foundation of industries that are currently in secular decline. The breakdown here isn't just about taxes. It's about the obsolescence of its primary economic engines. Now that you understand how high taxes and demographic decline can hollow out a state like Illinois, you must see how economic diversification, or the lack thereof, can be just as dangerous. The next state relied on a specific sector to fuel its growth, and now that sector is contracting, leaving the entire economy vulnerable. If Connecticut and Illinois are victims of long-term fiscal mismanagement, the next state on our list is a casualty of economic specialization. It proves that putting all your eggs in one basket, even a very productive basket, is a dangerous strategy when global supply chains shift. We are moving to the industrial heartland, where a specific type of economic breakdown is accelerating in the current cycle. Number 4. Michigan. Michigan has long been synonymous with American manufacturing. For decades, the automotive industry was the engine of its economy, providing high-paying jobs and a robust tax base. But in the current economic landscape, that engine is sputtering. The breakdown in Michigan is driven by the manufacturing transition. As the global economy shifts toward automation and electric vehicles, the traditional manufacturing jobs that supported the middle class are disappearing. While new plants are being built, they require fewer workers and often pay lower wages than the union jobs of the past. This structural shift is hollowing out the consumer base. We are seeing a divergence in real estate markets across the state. While pockets of affluence remain, many communities are grappling with population loss and stagnant property values. The legacy cost of maintaining infrastructure built for a larger population is a heavy burden on the remaining residents. Furthermore, Michigan's demographic profile is aging rapidly. The state is struggling to attract and retain young professionals. The brain drain of college graduates leaving for opportunities in other states is a critical issue. Without a vibrant workforce, businesses are reluctant to invest, creating a feedback loop of economic stagnation. For investors, Michigan presents a complex picture. While rental yields can be attractive on paper due to lower property prices, the long-term appreciation potential is capped by the state's slow growth. The risk of vacancy and tenant turnover is higher in areas facing economic decline. But if you think Michigan's manufacturing struggle is a regional issue, wait until you see the tech hub collapse happening in the next state. While Michigan loses its factories, this next state is losing its remote workers. The Zoom town, bust here, is a warning sign for real estate investors nationwide. Number 3. Idaho. Idaho was the darling of the pandemic era. It experienced explosive population growth as remote workers fled high-cost coastal cities for a more affordable and scenic lifestyle. This influx of capital drove real estate prices to record highs. But in the current cycle, the music has stopped. The breakdown in Idaho is a classic case of an asset bubble. Home prices surged far beyond what local wages could support. As interest rates rose and remote work policies tightened, the demand for housing in Idaho collapsed. We are now seeing one of the sharpest price corrections in the country. The local economy, which had pivoted to serve the influx of new residents, is now feeling the strain. Construction jobs, retail, and services that boomed during the migration wave are contracting. This economic slowdown is exacerbated by the fact that many of the new residents were retirees or remote workers whose income was not tied to the local economy. As some of them return to office hubs or move to cheaper locations, the local spending power evaporates. For homeowners who bought at the peak, the situation is precarious. Many are now underwater on their mortgages, owing more than their homes are worth. This negative equity trap makes it difficult to move or refinance, locking people into their properties. The inventory of unsold homes is rising, putting further downward pressure on prices. However, while Idaho deals with the aftermath of a speculative bubble, the next state on our list faces a fiscal cliff that is unprecedented in its scale. This next economy is so large that its failure poses a systemic risk to the entire U.S. financial system. Now that you understand how speculative bubbles can burst in states like Idaho, you must see how fiscal irresponsibility on a massive scale can threaten even the largest economies. The next state was once the economic powerhouse of the nation, but years of deficit spending and regulatory overreach have pushed it to the brink. If Idaho's bubble burst was a regional shock, the next state on our list represents a systemic failure that reverberates across the entire country. We are moving to the West Coast, where a once unrivaled economic engine is sputtering under the weight of its own success and mismanagement. This state proves that even with massive natural advantages, an economy can crack under excessive fiscal strain. Number 2. California. California has long been the economic powerhouse of the United States. It boasts a diverse economy with thriving tech, entertainment, agriculture, and manufacturing sectors. However, in the current cycle, the cracks are becoming impossible to ignore. The breakdown in California is driven by the middle-class exodus. For years, the high cost of living, driven by restrictive housing policies and high taxes, has pushed middle-income families out of the state. This demographic shift is eroding the tax base that supports public services and infrastructure. Furthermore, the state faces a massive budget deficit. California relies heavily on capital gains taxes from its wealthy residents and tech IPOs. When the stock market corrects or tech valuations fall, the state's revenue plunges. This volatility makes budget planning a nightmare, leading to boom and bust cycles in public spending. For real estate investors, California presents a high-risk, high-reward proposition. While coastal markets remain resilient due to scarcity and demand, inland areas are vulnerable to economic downturns. The regulatory environment, with strict rent control and tenant protections, adds another layer of complexity and cost for landlords. But if you think California's challenges are daunting, wait until you see the fiscal catastrophe unfolding in the next state. While California struggles with its budget, this next state is facing a demographic collapse combined with a manufacturing decline that threatens its very existence. Number 1. New York. New York is currently facing the most severe economic headwinds of any state on our list. The breakdown here is a perfect storm of fiscal mismanagement, high taxes, demographic decline, and a shifting economic landscape. The state has the highest tax burden in the nation, driving away both businesses and high-net-worth individuals. The exodus of wealth from New York City to tax-friendly states like Florida is well documented and continues to drain the state's coffers. Furthermore, New York relies heavily on the financial services sector for tax revenue. As Wall Street firms relocate or downsize, the state loses its primary source of income. This structural shift is exacerbated by the rise of remote work, which has reduced the demand for office space in Manhattan and eroded the city's tax base. For property owners, the situation is alarming. New York City has some of the highest property taxes and maintenance costs in the world. When you combine this with declining rents and rising vacancies, the economics of owning real estate become increasingly challenging. The state's pension obligations are also a massive liability, threatening future tax hikes or service cuts. So let's jump into conclusion. The strategic pivot. So, what does this mean for you as an investor or homeowner? If you reside in or own property in one of these 8 states, you are navigating a treacherous economic landscape. The risks to your equity and financial stability are real and growing. However, this does not mean you should panic sell. Instead, it requires a strategic pivot. First, diversify your portfolio. If your wealth is concentrated in a state facing economic decline, consider reallocating capital to more stable markets with favorable demographics and business climates. Look for states with lower tax burdens, growing populations, and diversified economies. Second, focus on cash flow over appreciation. In states with stagnant or declining property values, the primary driver of returns will be rental income. Ensure your properties are generating positive cash flow to weather any downturns. Third, stay informed. Monitor local economic indicators, legislative changes, and demographic trends. Being proactive and adaptable is key to navigating these challenging times. Finally, remember that every crisis presents an opportunity. While some states struggle, others will thrive. By identifying the winners and losers early, you can position yourself to capitalize on the shifting economic landscape. The economic map of the United States is being redrawn. Don't be left behind on the wrong side of the border.